In this video, I'll talk about how to get a mortgage pre-approval in Canada, the difference between pre-qualification versus pre-approvals, the documents you need to provide to the lender, and whether you should work with your bank or mortgage broker, and lastly, the different types of mortgages like variable rates and fixed rate mortgages. Hey everyone, Fawad Nissari here with eXp Realty, and welcome to the second part series on how to buy your first property here in Canada in 2023. If this is your first time on this channel looking to get some insight into the Canadian real estate market, well, you're in the right place. I create weekly educational content related to the Canadian real estate market updates, interest rate changes, and everything about buying and selling real estate. If you're into this kind of content, consider subscribing, hit the notification bell so you're notified as soon as we upload our next video. All right, let's talk about how to get a mortgage pre-approval. Now, if you're considering buying a property, I'm sure you've stumbled across these online websites where they claim they can get you approval in minutes, guaranteed approval, etc., etc. But is it that simple? Not quite. The reality is, unless you provide all your documents, it's not a real mortgage pre-approval. So what do you need to do to get a real mortgage pre-approval? I'm glad you asked, and here's a list of documents you would need to submit to your mortgage broker or bank to get your pre-approval process started. You would need to provide your latest employment letter, pay stubs, T4s, and notice of assessment, 90-day bank statement, and proof of down payment. And then finally, they will pull your credit and go through a complete application process. Typically, it takes a few days, although it can take longer in some cases. It all really depends on how fast you can supply all the documents. Now, just a quick piece of advice, please do not submit screenshots of your documents. Banks will never accept those. Make sure every single document is in a PDF format. Once you get your pre-approval, it's good for a period of 90 to 120 days. That'll give you enough time to look for a property, and some lenders will even allow an extension to your mortgage pre-approval, so it really depends on case-by-case basis. Now, this pre-approval also comes with a rate hold. Let's say you're pre-approved by one of the major banks with a 5.5% fixed rate. This rate is guaranteed for the next 90 to 120 days. So even if the interest rate goes up, your rate hold will stay at 5.5%. But here's what you need to know about rate holds. Rate holds do not apply to variable rate mortgages because variable rate fluctuates based on the Bank of Canada's overnight rate. Also, if your financial situation changes after getting your pre-approval, like changing jobs, buying a car, or taking on a new loan, your mortgage pre-approval could be revoked. So try to hold off on making those changes until you close on a property. Now, what's the difference between a variable mortgage versus a fixed mortgage? Well, to put it in the simplest term, a fixed mortgage locks your rate for a period of time, say 5 years. It doesn't matter if the interest rate goes up or down, your monthly payments, including principal and interest, will not change for that period of time. Fixed rates are typically higher than variable, but provided consistent mortgage payments for years to come. Now, just a side note, obviously fixed rate these days are lower than variable rate because they're projecting that the rate's gonna come down in the next year or two. That's why banks are pushing people to get fixed rate mortgages instead of variable rate mortgage, because if people were to break their mortgages, there's a higher penalty for fixed rate mortgages. So let's talk about that. If you break the term, there's often a bigger penalty. Say you got a 5-year fixed rate mortgage on your house and you have plans have changed and now you want to sell your house. Well, if you break your mortgage, you will pay a very high penalty, somewhere between $30,000 to $40,000 depending on the mortgage amount. The reason for that is because fixed rate penalties are calculated based on interest rate differential, meaning paying back the interest owed until the maturity of the term, which could lead to tens of thousands of dollars. It's also not possible to switch a fixed rate to variable rate without breaking the mortgage. Now, with variable rate, however, your rate changes over time with the Bank of Canada's prime rate. How does this work? 8 times a year, the Bank of Canada gets together and determines whether or not to adjust the overnight rate. And their entire purpose is to control inflation. And unless you're living under a rock, the last rate hike marks a 10 rate increases since March of 2022 to tame inflation. Now, the current Bank of Canada's rate is sitting at 5%. Now, one thing to note, within the variable rate, there are 2 products that banks offer. A variable rate mortgage is one where the interest rate changes with the overnight rate, but the monthly payments are always the same unless you hit your trigger point. And as of this recording, at least 80% of CIBC mortgage holders who have variable rate mortgages have hit their trigger rate, meaning their monthly payment does not even cover the interest portion of the payment. Again, a whole different topic to talk about on a next video, but moving on. Now, The other type of variable rate is called adjustable rate mortgage. This is where the monthly payment can change when the Bank of Canada overnight rate increases. Let's say you got a house and your monthly payment was $2,000 at the beginning or middle of the pandemic. Now it will most likely be $3,400 due to all these rate increases. Now most traditional banks like BMO, CIBC, and TD offer the traditional variable rate. Sometimes I believe even RBC offers traditional rates. Only one bank that I know of, and that's Scotiabank, that they offer adjustable variable rate. Now, if you break your variable rate mortgage, the penalty is typically a lot lower than fixed rate. Variable penalties are calculated based on 3 months interest. The penalty to break your variable rate would be around $12,000. But if you had a fixed rate, the penalty would be around $30,000 to $40,000. So that's essentially the difference between fixed rates and variable rate. Now, who can give you a better rate? Your bank or a mortgage broker? Well, if you go to your bank will only provide the product they have available within their organizations. And also, whoever you talk to at the bank, they're salaried employees, so they don't care if you get a good rate or not. They're just there to do their job. See, mortgage brokers, they can present multiple mortgage options. Plus, they're on commission, so they're going to work hard to get your business. They will go and negotiate the lowest rate for you because they have high volume of business with different banks and lenders, and they can possibly get you a discount and a better product. So working with a mortgage broker ensures that there's somebody who's going to make sure you get the right product and there are no surprises on your closing day. Okay, now that you know how to get your mortgage pre-approval, know exactly what you can afford, it's time to pick your team to help you with your home search. Now, if you got any value out of this video, please smash that like button so more people like you can watch these kind of videos. And on the next video, I'm going to talk about how to pick your team and some tips and tricks to not end up with the wrong agent to help you with your biggest purchase of your lifetime. Thanks for watching, and I'll see you on the next one.